Right, guys, let's quickly take a look at that upcoming ISM non-manufacturing or services PMI from the US. Now, the very first thing that we need to just keep in mind going into this print is yesterday's reaction function that we had going out of that JOLTS job openings data. That JOLTS print was pretty bad, right? It decelerated to below the market's minimum expectation. We got very, very close to that 8 million number. And if we just put that chart into perspective once again, let me just show you guys here. There we go. That was a very big drop in job demand for the US economy, right? Yes, there was a small uptick in the quits rate, which does ease up some of that concerns about job demand, because if there's more people that is willing to quit their jobs, it's because they think they will be able to get a new one. When you start seeing demand drop drastically and then quits drop drastically alongside that, that's very, very negative, right? Because that shows far less demand and people are not sure whether they will be able to get a job anymore if they go out to look for one. Bottom line is, at 8 million or very close to that, it was a pretty negative number. Very, very big deceleration in job demand. However, if we take a look at how the markets reacted, and this is the first thing that we just need to keep in mind going into this ISM, is that the reaction to JOLTS was pretty mediocre. The dollar had that first initial push to the downside, and the market was able to pare that back fairly quickly, and we're already trading higher as of today's session compared to yesterday's high. That is not the way that you would have expected the markets to react, right? Even equities, even though we did push up eventually, the initial reaction was a small move higher, and then the markets completely pared back that move. Now, again, equities eventually rallied up, and we did eventually see yields pushing lower, but the initial reaction wasn't very tradable out of that JOLTS print, or at least the reaction function wasn't how we would have expected it to react based on the outcome that we had. So that was the first risk that we need to keep in mind. There is a risk that, maybe today we see the same type of reaction out of the ISM. It is important to understand that the ISM services is obviously far more important and timely compared to that of JOLTS job openings. So there is reason for the markets to worry more about this. There's even reasons for the markets to worry more about this compared to the ISM manufacturing that we had on Monday. And the reason for that is because services is by far a much bigger share of the economy, right? So there is reasons to expect that maybe we see a punchy move out of this print, but there is a risk, just like yesterday, that maybe we see that same type of messy, lackluster reaction. For that reason, personally, I'm just going to reduce risk a little bit if I am going to trade this, if we obviously get the outcome that we're looking for, because yesterday was a bit of a dud with it. So I will just be reducing risk slightly in the event that we do see another, strange reaction coming out of that, or at least a counter intuitive reaction coming out from that ISM services. Now, just like the manufacturing print, as we explained on Monday, when we approach something like the ISM non-manufacturing, we can't just look at the headline PMI number. If we just look at that number and try to trade out of that, that's going to get us into trouble. We have to assess the entirety of the report. We can't just look at the composite. Remember, the composite is just made up of all of the other sub-indexes. So we can't just look at the PMI. We need to understand what's happening to business activity, what's happening to employment, what's happening to new orders, what's happening to prices paid. All of these things together gives us the ISM report. We can't just look at the headline. We need to include all of them. Now, when it comes to tradability, what we ideally want to see here is all of these things telling us the same thing. We want to see the majority of them coming in really bad or the majority of them coming in really good. What we don't want to see is some of them coming in really, really good and some of them coming in really, really bad. That normally doesn't give us a great amount of conviction to trade, because the markets can interpret that. The moment that it's mixed, the markets can interpret it any way they want. And that doesn't really give you an edge to trade out of the event, right? You want to have that type of outcome where once you see it, you know how the market should react. Obviously, JOLTS yesterday was a very good example of even in times when we get that overwhelmingly dovish or hawkish outcome, or overwhelming bad or good print, we don't always see the expected reaction, but we go based on probabilities, right? We have to trade based on probabilities. Nothing is going to give you 100% surety when we trade. So those are two important things to keep in mind about today's print. The first one is that we didn't see as big a reaction out of JOLTS as we would have expected to. And the second one is we can't just look at the headline. We look at all of these measures and we are looking for a move across the board as a miss or a move across the board as a beat. Just on that first point though, in terms of the JOLTS print, ING was out with some interesting takes this morning on why they thought the dollar didn't react to JOLTS. They were surprised by the lack of reaction as well. And they actually said that they think the stress that we had in the markets yesterday from a risk sentiment point of view was mainly triggered by some of those very favorite carry trades that just got unwound quite a bit. And obviously the huge amount of price action we saw in the likes of the Mexican peso, specifically the Mexican yen pair, as well as obviously the yen itself with the bond market news that we got. There was a lot of carry unwinds that could have led to some of that increased volatility, just spurring some additional support for the dollar. So that is just something worth keeping in mind. You know, they did offer some reasons for why they thought JOLTS didn't see the reaction that we would have expected to see. And we don't see those same types of moves today. So there is reasons to expect that maybe we see the same type of reaction that we would expect. But again, we can't be sure of that. We need to consider what happened yesterday. Now, having all of that said, what type of numbers are we looking for today's print? Now, for that, I've just, drawn up a little table. Again, it's just easier to look at it this way, showing us where those clear lines are, those clear thresholds are for what we'll be looking for. Now, in terms of the headline number, the composite, we know that expectations for this is for a slight uptick. The prior is 49.4, and the expectations for that is to tick up slightly to 50.8. Now, for me, for this one, I'll be looking for anything as close to or below as we can get to 49. Just below 49, 49.4 could do the trick, because 49.4 is obviously the prior, but the market's minimum expectation is 49.1. So anything in line with that or lower should do the trick. But again, if we just print below the prior, which is 49.4, that might be enough as well. In terms of prices paid, we know that the prior number for prices paid, let me just show you guys that. The prior number for prices paid came in at 59.2. That was a whopper of a number. Let's just quickly go there to show you that on the chart. Big jolt to the upside for prices paid last time at 59.2. Now, what we'll be looking for here for a trade on the miss, anything below 59.2, the prior should do the trick. We don't have consensus for this. We don't have a minimum and a maximum for this. So we only have the prior to work with. So anything below 59.2 should do the trick. But, the closer we can get to 53.4, the better. Why 53.4? Well, take a look at the chart again. 53.4 was that last low, going back to March. If we see a complete reversal of that initial pop to the upside, that'll be seen as pretty dovish, right? That'll show us that, hey, that scare the markets got into out of that prior print, it's null and void, right? It was a flash in the pan. Noise. So if we see that going down, the closer we can get to 53.4, the better. So just below prior should do the trick, but the closer we can get to that March low, I think the more attractive that type of miss will be. Now, the next one we've got on the radar is obviously employment. Now, for this one, super easy. We don't have an expectation. We don't have a minimum. We don't have a maximum. So just below the prior of 45.9 should do the trick as a miss. In terms of new orders, this one is slightly more tricky because there the prior is 52.2. I don't just want to see it below 52.2. I want to see it breaking that 50 level, basically pushing into contractionary territory. The exact same story for business activity. If we take a look at business activity, there we actually do have estimates. Business activity is expected at 53 from the prior of 50.9. Minimum is 51. I won't be looking for a move below this or this. I want to move below 50. I want a move into contractionary territory to really shock the markets like, wow, that's a negative print. That's on a miss. What about a beat? Well, if we look at the expectations once again, I think anything in line or above 52.5 should do the trick. Why 52.5? It's the market's maximum expectation. Let's just keep it simple when it comes to that one. In terms of the prices paid number, above 60, equal to above 60 should do the trick. Why 60? Again, if we go to the chart, the prior print was 59.2. So above 60 just gives us that psychological level, right? Saying with prices paid above 60, that should get the market attention, especially from a services inflation point of view. So above 60, in line with or above 60 should do the trick. Employment, above 50. Why above 50? We just want to see it going into expansionary territory. right? The prior print for employment was 45.9. So it's a big jump to get to above 50, but we saw it happen with the manufacturing. Where's manufacturing? Here we go. Manufacturing went from 48.6 all the way up to 51. So yes, it's a big jump to get there, but that'll be super bullish if we get that, right? Or super hawkish for good for the dollar, basically, if we can get that back above 50. New orders, 52.2. Above that should do the trick. Why 52.2? That's the prior. So anything above that should be fine. Business activity. This one, I said above or equal to 55. Why that? Because that is the market's maximum expectation. But man, that's quite a jump, right? I mean, from 50.9 all the way up to 55, it feels like an unnecessary beat, right? So that's why I said, anything above the prior might do, but obviously as a bare minimum, we want to see it above 53, right? 53 is the market consensus view. But again, if all of the others are positive and that comes in above the prior, it should be enough to come out as a positive number again, considering this is services. Now, just like we explained yesterday, what is the expected reaction across major asset classes if we do get a miss across the board and a beat across the board? For a miss, what we would expect is dollar downside, yields downside, equities up, precious metals up. On a hawkish outcome, we would expect the opposite. Dollar up, yields up, equities down, gold down. Now again, this is the regular expected market reaction. We saw some of that yesterday, but the markets discounted those initial moves incredibly fast. So don't hold a gun to my head and say, hey, you said this is how it's going to react. This is the expected reaction. There's no guarantee that we're going to see the markets react this way. This is the regular way that we would expect them to react, but there's no guarantee that we see that, right? Now, what about a possible trade plan? Well, in today's session, we are once again seeing the Kiwi dollar as the strongest currency on the session. So if we do see a huge miss across the board in those data, I'll be looking for some Kiwi dollar long opportunities again, just like we were with Monday's ISM manufacturing trade. We are getting close to some pretty key levels of resistance. So the first one to watch there would be 62 psychological, and above that would be the implied volatility high, marrying up nicely with that high going back to the 8th of March, the high going back to the 22nd of Feb. So 62, between 62 and 62.20 will be some pretty stiff resistance to watch on any type of dovish outcome of that print. The other one we could consider is ES longs. Now I said maybe here. Why maybe? Because again, we need to acknowledge that equities didn't react positively to the data yesterday, right? And we didn't really see a lot of follow through out of the ISM manufacturing as well, which is a little bit of a risk, obviously. So I do want to trade this higher if it is a solid miss, but the risk is that we see that inaction, that lackluster reaction again. That is a bit of a risk. But if we do see a nice reaction, levels to aim for, obviously all-time highs would be the first one. To be fair, the first one would be 53.20 with the high going back to the 28th. Above that would be a move back up towards all-time highs at 53. Let's just call it 53.50. That'll be key levels to watch to the upside on the back of a miss. The other one, dollar CAD short if the BOC is hawkish. We obviously get the BOC coming out before the ISM. So if they come out incredibly hawkish and we see the dollar CAD push lower, if we then get a huge miss in the ISM, it should just provide us with some additional opportunities to chase the dollar CAD lower. Obviously, if dollar CAD at the time is already trading at like 135, I'm not going to go chasing it lower, right? But if we see a hawkish reaction and there's still some room left to run to the downside, and we then get a miss, then obviously we can look to trade it back down towards some key levels of support that we noted earlier in the BOC video. Now, what about the other side? What if we get a super strong print today? Now, again, saying a beat across the board doesn't mean that all of these things needs to be exactly perfect in this scenario. This just gives you a broad scenario to work from, right? Saying this is the ideal prints, but anything more or less close to that should be enough for a trade. So we don't have to see these exact numbers. These are just, it's a threshold, right? It's think of it as a band that we're using, saying that something in that vicinity across the board should be good enough. What can we look to trade if we do get a strong number? I'm still liking the Aussie to the downside, as you guys know. So Aussie US dollar downside seems like a good opportunity. Move back down towards that 66.20 area, still what I'm watching. And below that, we've got a potential key level of support coming up at that 66 cents level. So that'll be key to watch to the downside on a strong beat. The other one we can consider is some some gold downside. We spoke about this yesterday, or Monday rather. Why we like this lower? We know that a risk reversal still suggests downside risk from a options market point of view. Let me just show you guys what I mean by that. If we quickly open up risk reversals here. Here we go. Suggesting downside risk from an options market point of view. And apart from that, you guys will remember this chart from Monday as well. Positioning incredibly stretched on the long side for gold right now. Huge amount of accumulation that got in from obviously from a contract point of view, but point is positioning stretch. So gold shorts could be on the cards on a super strong number for a possible rotation back down towards 2292. That level, key support going back to April and obviously early May. Key one to watch to the downside. The other one that we could consider, again, based on the BOC, is if the BOC is super dovish, i.e. CAD downside, we could potentially look at dollar CAD longs, if ISM comes out super strong. Obviously, if the BOC is very dovish, we might be trading into key resistance at that time anyway, but key levels to watch would be the high going back to the 30th, the high going back to the 23rd, the 8th of May, and obviously the one going back to the 30th of April and the 1st of May as well. Key levels to watch to the upside from a resistance point of view. So that's just a preview and a trade plan for that ISM services coming up. As always, any questions, don't hesitate to let me know.